Hey everyone, Couch Investor back on our earnings video for today. So Disney just reported their quarterly earnings. It was a beat on the EPS side, a small miss on revenue, but a big beat when it comes to the subscribers added. And they're doing some great works when it comes to cost cuts. They've also promised us that fiscal year 2024 will see a big rise in free cash flow, levels not seen since pre-pandemic. So that's extremely positive for shareholders. Now, for those of you that needed a small reminder as how, let's say, cheap-ish Disney stock is currently trading at, Disney at the time of making this video is up just under 3%, market cap $154.7 billion, forward PE currently 19.6 times. Now the mean, I put it the last 10 years. 10-year mean here for forward PE, 32.3 times. But if you remove, let's say, the pandemic period where PE was extremely elevated, I believe we are sitting at just around the mean. Same thing with regards to EV to EBITDA, price to sales, both of them in the next 12 months. Right now, much below the 10-year mean, also much below the 5-year mean, by the way. Then with regards to price to free cash flow in the last 12 months, of course, that has fluctuated when they had free cash flow, when they did not have free cash flow. But right now, free cash flow is growing, and they promise that next year it's going to grow even more. So expect that graph here, that line, to drop a bit as well. And so let's start here with a couple of key points. So Disney Plus added nearly 7 million core subscribers in the fourth month. I believe the estimates were more around 2.4, 2.7 million or so quite a nice beat. Then with regards to profitability, so they continue to expect that our combined streaming businesses will reach profitability in Q4 fiscal year 2024. They continue to aggressively manage their cost base and have increased the annualized efficiency target to $7.5 billion versus $5.5 billion previously. And like I said, they expect to grow free cash flow in fiscal 2024 significantly versus fiscal 2023, approaching levels last seen pre-pandemic. This continued robust free cash flow growth alongside our strong balance sheet will position us well to address our investment and shareholders' goal for the year and going forward. Now, a couple of comments here from the CEO, Robert Iger. Our results this quarter reflect the significant progress we've made over the past year. While we still have work to do, these efforts have already allowed us to move beyond the spirit of fixing and begin building our businesses again. Combined with our portfolio of valuable businesses, brands, and assets, and the way we manage them together, Disney has a strong hand that differentiates us from others in our industry. As we look forward, there are 4 key building opportunities that will be central to our success. 1. Achieving significant and sustained profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output and economics of our film studios. That's going to be a good one. And turbocharging growth in our parks and experience business. And by the way, with regards to ESPN, earlier in October, there was this headline here: ESPN may be worth $22 billion based on first look at results. Now, before I continue and jump into the numbers, which by the way are now much better presented than before, there's been a whole restructuring in the earnings report, so that's great. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the links down in the description or in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, revenue increased just 5% year over year, and then for the whole year that increased 7%. Total segment operating income increased 86% year over year for this quarter and 6% for the whole year. Diluted EPS from continuing operations that increased 56% to 14 cents, but for the full year that's down 26%. Free cash flow, huge increase there. For this quarter last year was 1.37 billion, we're now at 3.42 billion. Then of course for the full year as well, huge increases. Then we now have different segment revenues to look at. So we have entertainment, sports, experiences, and then eliminations here, but hey, let's just focus on the top 3 here. So entertainment increased 2% year over year, sports basically flat, and experiences, as always, that's the one dragging the business forward, 13% increase year over year. Then with regards to operating income, so entertainment was negative same quarter last year, now positive 236 million. Sports increased 14% year over year, and experiences increased 31%. So total segment operating income increased 86%. And now we can go even a bit deeper. So we first start with entertainment. revenues, linear and direct to consumer. So linear is down 9%, direct to consumer is up 12%. But then, of course, we've seen a major improvement in operating income with regards to DTC. So that increased 70% year over year. Still a loss, but hey, that's already a nice improvement there. With regards to linear network, so revenue domestically, internationally, all of them are basically down 9%. Operating income is down 5% domestically and 3% internationally. Then as for DTC, so the decrease in operating loss was due to higher subscription revenue attributable to increases in retail pricing at Disney Plus Core and Hulu, and subscriber growth at Disney Plus Core and Hulu as well. Lower marketing, technology, and distribution costs, and an increase in programming and production costs due to higher subscriber-based fees for programming the Hulu Live TV service, attributable to more subscribers and rate increases. And now we get the rundown of the paid subscribers, so Disney Plus domestically, internationally, Disney Plus Core, and Disney Plus Hotstar. So we've got an increase of worth 1% domestically. Internationally, that increased 11%. So Disney Core overall is up 7%, and that's quarter over quarter. Disney Plus Hotstar is down 7%. We've also been talking about them selling the India business to raise approximately $10 billion. Remains to be seen what happens with that. Then with regards to Hulu, so SVOD only, basically flat. Live TV plus SVOD is up 7%, so total Hulu is flat. And then how much money are they actually making per paid subscriber? So Disney Plus Hotstar, I'll start with the biggest increase here. It's a large increase quarter over quarter, but still just 70 cents. Disney Plus Core increased 2%. Domestically, that increased 3%. Why is that? Well, due to higher advertising revenue. But if we look at Hulu, both of them here decreased 2%, and that's because lower advertising revenue and a higher mix of subscribers to multi-product offerings. Up next, we have the sports segment. So revenue for ESPN, domestically that increased 1%, internationally just 2%. If you look at the operating income, domestically that increased 16% year over year, internationally that decreased 79%. And here with regards to the paid subscribers, so that increased 3% quarter over quarter. As for how much money they're making, that's down 2% quarter over quarter. Then the last big segment here is obviously experiences. So parks and experiences domestically, that's up 7%. And then not surprising, international, that's up 55% year over year. And so with operating income, same thing there as we've seen last quarter. Domestically, that's up 9%, but international is up over 100%. Of course, one of the reasons is this. So higher international parks and experience operating results were due to one, an increase in operating results at Shanghai Disney Resort, and higher operating income in Hong Kong as well. So guest spending is attributable to an increase in average ticket prices and higher volume due to an increase in attendance. And so overall, pretty positive report with regards to Disney. Now, before we conclude, this is what we're looking at right now with the graph. We're going to make a little push, I believe, tomorrow towards that 200-day moving average, which right now sits just at $90. Of course, as always, this area right here between $80 and $85 has been a type of support area for quite a couple of times in the last couple of years, actually going all the way back to 2014, as we've discussed in previous videos. So currently, maybe this was the bottom, $80. Right now, we're trying to make a little push. After hours, we're up 2 to 3% or so, going to make our way towards that 200-day moving average at $90. So overall, pretty positive report for Disney. Lots of promises with regards to cost cuts, profitability, growth with free cash flow, which should be well received for all investors. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.